When we think about the landscape that we just described, sticky inflation, era of elevated volatility, less predictability around stock bond correlations, and the cone of outcomes being quite wide, key word that will continue to repeat is diversification. And an area we really like and are seeing a lot more interest in is infrastructure. And why that is because, well, first, it's a asset class that typically is backed by hard assets and often by essential services hard assets. Third is, I think we all probably appreciate, there's been an underinvestment in all types of infrastructure, not only here in the US, but across the world. That's beginning to change. People are recognizing that infrastructure is critical to success and GDP growth across, every country and across the globe. It also represents a pretty good inflation mitigant, right? We talked a lot about sticky inflation. A lot of the infrastructure types have pass-through clauses in terms of renting, pipelines and things of that nature. So it's and a hard asset and a real asset, as I said earlier. So some of the areas we like would include digital infrastructure. I think for the obvious reason, a subcomponent of that, and we kind of like to think of the AI palooza that's going on here. It's hard to know who the winners and losers will be, but if you think about the picks and shovels, right? What will certainly be left standing? Data centers, the need for compute, things of that nature. And so we think, pick and shovel, the data center operators would be a really good example of that. In essential services, which I mentioned earlier, we have transportation, utilities, energy transmission, plenty to pick from in that area. I'll just click off maybe a couple more sub areas that we like lined up against some of the themes. I mentioned AI and the picks and shovels. I'll add a couple more in. In addition to the data centers, fiber, power, right? We've all read and heard about how much power AI is going to be using, regardless of who the winners or users are. This is a powerful, transformational technology that we're entering into, and it will demand a ton of power. Energy transition and sustainability. I mentioned a couple of them: transmission and distribution, gas storage, transport. Plenty to pick there. Geopolitics, we touched on it. That is a massive secular theme as people look inward and new alliances are being created. It creates a lot of opportunity. Industrial onshoring, certainly security and defense, energy security, right? We're living this right now. And so those are the kind of themes within this geopolitical shift that we're seeing. And then just the overall macro uncertainty, trying to find uncorrelated yield, uncorrelated returns. If you look at infrastructure compared to equities and fixed income, correlations are low. And I'll just give you a couple of data points. On equities, the correlation to infrastructure is about 0.5. For fixed income, it's 0. So when we think about the things we said earlier, less predictability in public stock bonds, inflation, volatility, uncertainty, we think infrastructure is really a very interesting asset class and worthy of allocation within portfolios.
One area too, I think that you just kind of touched on is the supply chain resilience and the infrastructure that's going into there, kind of a peripheral side, but the onshoring, nearshoring, that's really kind of changed since the globalization hit its peak some time ago, is that's going to create a lot of different areas that when you look at these shipping and you look at the roads and you look at just some of the infrastructure needs on those, that just that side of it's going to amplify too. And then the other thing I would just say is remember the interdependence with commodities. As Cliff mentioned, the hard assets is so crucial, but having those hard assets in those portfolios again lowers the correlation. If you look at the two, investments that can lower a portfolio's correlation, it's currencies and commodities. That's historically been proven out. So it's probably getting to that time. It may not be a spike like we've seen in the last 20 years, but it might be this consistent need and demand and so forth. And I know McKinsey came out and said the more we put off these investments in infrastructure, the bigger that need is. They're now saying just basic infrastructure needs are about $106 trillion that's going to be needed between now and 2040. So this number is getting bigger, not smaller, the more we put it off.
Yeah, I would just echo that is obviously a gargantuan number Matt's talking about. And then just one other stat I neglected to throw in there, so I'll throw it in now. If you looked at the average quarterly returns during the 10 worst quarters for equity markets over many years, Equity down 7.73, fixed income down 0.82, and U.S. private infrastructure up 1.08. So just emphasizing the point about diversification, particularly in downside markets. We want to make sure, obviously, make sure we're protecting against the downside.
I just add, I think Cliff hit it right on the head when we talk about, or when we think about the infrastructure theme. I think there's a couple things that are really the top selling points. One is sort of the secular tailwinds behind some of these, and you mentioned the AI build out, the energy infrastructure build out. I mean, these are huge numbers. So you have these secular growth trends. You've got really attractive yields. And then what I think has become really evident just in the last month or so is the diversification benefits that you get, because these have much lower correlations to the traditional equity and fixed income markets than really what you're finding in traditional stock and bond allocations. So, combination of long-term secular growth trends, really attractive yields, and great portfolio diversifiers really make it a compelling case.
All right.